My name is John Henley. I'm from Atlantic Capital Advisory, and I advise clients globally in relation to yacht finance. So I'd like to address the question, why do people finance yachts? Because a lot of people in the industry that I speak to would ask why a client would want to finance a yacht, or they would say that surely clients have the means to buy a yacht, they don't need financing. The cost of debt, I would say, is often cheaper than the cost of equity. So for a lot of clients, it's optional. Clients often have different options for the use of the liquidity and capital that they have. They've typically in this industry been successful entrepreneurs. They've generated wealth, or they've inherited wealth and they need to preserve and grow it. And investing capital into a yacht isn't necessarily the best way to grow that wealth and grow that investment. Introducing leverage and limiting the equity capital that they invest might be helpful for some clients. So I'm an advocate for credit and lending, and I would always encourage clients to at least consider the financing option, again, just to be optimal and efficient with the equity that they have. Some clients are in a position where they're looking for financing because they perhaps have greater aspirations right now than their current liquidity would allow them to purchase. So they may have 3 or 4 million to invest. They could buy a 3 or 4 million yacht outright, but maybe they could buy a yacht for 7, 8 million if they took leverage. And that might be the yacht that they prefer. They may have liquidity events further down the road because they're selling a company or inheriting some assets, or there is cash coming their way to repay that debt in the future, or they may have a healthy income that will allow them to service the debt on that yacht going forward. And again, it allows them to order and enjoy a larger asset than they might otherwise be able to. But either way, yacht financing is available in the market. The other thing I'll talk about is who the yacht lenders are in the world. So I'll break that down into 3 key lender pools, as I would call them. So the first one is the private banking community. So the private banking community are heavily centered in Europe and the US, and there are a significant number of private banks that have appetite to finance yachts. They typically focus on the larger yachts, so I would say sort of 40 meters and above, lending values of around 10 million euros or the dollar equivalent and above, and they're there really to support their larger value clients from a relationship lending perspective. They typically offer financing as part of a broader relationship, so sometimes that's very formalized, and so those lenders might say, we will provide you with, 20 million euros of financing, providing you have a relationship with us and we're managing assets for you worth a reasonable proportion of that. And that reasonable proportion could be anywhere from 20 or 30% of the lending value to sometimes more than 100% of the lending value. And so that isn't always that attractive for clients, especially those clients that perhaps don't have that much liquidity right now available. Their funds might be tied up in assets, corporate investments, or they may just not want to alter the banking relationships they already have and have had for some time. So that the private banking solution works for some clients, but not for all. But it does serve yachts at the higher end of the market. So there are very few lenders that have appetite to finance yachts of 40, 50, 100 million euros. And so if you're in that market, it's really only the private banking community that's available that have frankly the balance sheet scale and the appetite for single asset, single client transactions at that end of the market. There are a few exceptions, so I'm generalizing a bit, but really that's the private banking market. Then I'll talk about the commercial lending market, or what I'll call the dry lenders. So these are lenders in the market that have appetite for yacht financing, and they have appetite to lend to clients for yacht financing secured against the yacht only. So they're not really interested in broader banking relationships or transactions. They really just want to do a credit transaction with a client. And typically that's what clients are looking for. When they're thinking about yacht finance, they don't really want lenders asking for other assets from them or other business from them. They really just want a credit transaction. Those lenders are typically smaller institutions and would probably struggle to lend beyond maybe 10 to 20 million euros or the dollar equivalent. So for assets at the sort of smaller to medium end of the market, the dry lenders are quite suitable. Now they can be a little bit more expensive than the private banks, because the private banks would incorporate a relationship component into the terms that they would lend. So they may be able to lend a little bit more against an asset. They will probably lend a little bit cheaper than the commercial banks or dry lenders will. But again, the dry lenders are only interested in that single transaction with a client. So that's quite attractive for some clients. There are some transactions and clients that perhaps wouldn't qualify for those commercial lenders, and that might be because perhaps the asset's too old. Sometimes clients are looking for a finance facility in a short space of time. It could be that, I don't know, for example, somebody's ordered a vessel, it's due for delivery at the end of the month, they had intentions to purchase it without leverage. For some reason there's a delay on them getting the liquidity to fund the final purchase price. It may be that they plan to sell a business or a home or some other asset to fund that, and for whatever reason that's delayed, and they're in a position where they expect liquidity to come in a short space of time, but they have an obligation to purchase a yacht before that liquidity event will occur. And so for those clients, a bridging lender might be more suitable, and those bridging lenders are often funded with private equity or credit funds. The good thing with bridging lenders is that they can be very flexible and very reactive, and so for clients that need funds in 2 or 3 weeks, for example, sometimes those lenders are suitable. So for some clients that want short-term, fast liquidity to purchase a yacht, or sometimes to release equity from a yacht. You know, some clients, for example, purchased a yacht outright a number of years ago, they've enjoyed it, they have an opportunity, perhaps a commercial opportunity or some other investment opportunity, they need liquidity quickly to make that opportunity, perhaps their assets are tied up, and they're looking around at their investment or asset portfolio to think about what could I release liquidity from. If they have a large yacht that's owned without leverage, perhaps short-term bridge financing against that asset will allow them to release liquidity for other commercial investments that will generate returns for them that will be well above the cost of debt on the yacht in the short term. When it comes to financing a yacht and how to do it, what some borrowers or buyers might do is go to the market with a bit of a scattergun approach, and they'll call every lender they can find. They may do some Googling, speak to various people in the industry. They'll call private banks, they'll call dry lenders. But I think, you know, given what I just mentioned about the broad requirements of those different lender pools, I think it's helpful for buyers and owners to understand or have a think about what sort of terms that they're looking for, so that they're not wasting their time calling the lenders that aren't going to be able to give them what they want. You know, having a conversation with a large private bank against yacht financing, if you don't want a broader relationship as part of the transaction with that bank, is probably wasting an owner's time. And sometimes clients can spend weeks, if not months, having these conversations with lenders and then feel a little bit upset at the end when they find out that actually it's not what I thought it was going to be. It's also important to think about the construction side of things. So if an owner or buyer is looking for a brand new build and they're required to make progress payments during construction, are they looking for finance for those? And that's almost a different transaction altogether, because there a lender is not looking at a completed asset, they're looking at an incomplete asset. They're taking construction risk on a builder. It could be here in Germany, it could be in the Netherlands, it could be in Turkey, it could be in an array of different jurisdictions, and a lender will want to understand where in the world that yacht is being constructed, what are the credentials of the builder. They would also want to go into the details of the financials of that builder to make sure that they're financially stable and robust enough to actually complete that project, which may not be delivered for 1, 2, or 3 years' time. So it is quite a bit of work, and the risk is higher for that lender as well, and for the owner, because they're putting money into an asset that frankly isn't complete, and if anything should go wrong in the construction phase, it's a lot more complicated to resolve that sort of situation. So frankly, very few lenders globally are interested in providing construction finance. There are some, but they will be very selective in the shipyards that they're prepared to work with for construction financing, and the clients and the types of yachts that they would be prepared to provide construction financing for. So again, thinking about this early on is important, and I would encourage buyers to think about this before signing a purchase agreement with a builder as well, or a construction agreement. One of the reasons I say that is I often talk to buyers that have signed a purchase agreement, they've made a series of progress payments, and at that point they're thinking about needing financing to fund the remaining installments to the builder. Now, if that purchase agreement is with a reputable yard of good financial standing and what would legally be considered a safe jurisdiction, they may be okay, but a lot of the time buyers would find out that actually the title to the yacht under construction stays with the builder until they deliver it, and they don't actually have any security, in terms of the yacht at least, to offer a lender as security or collateral for construction financing. And so it's really not financeable without other assets as security during the construction period. So again, understanding that up front and perhaps negotiating into the purchase agreement at the outset, if you're looking for construction finance, and some security from the builder behind that, or to to support it is quite important. I think owners and buyers would need to think about what they intend to do with the yacht as well. That's quite important for lenders. Understanding where in the world they plan to use and operate it. Do they intend to charter it? Is it going to be private operation only? These considerations are important for lenders to understand the risk. A yacht that's going to spend its time in the Mediterranean in Northern Europe is considered a different risk to a yacht that might be sitting somewhere in South Asia or somewhere a lot more remote that might be more challenging for a lender to recover an asset should anything go wrong. Owners also need to think about flagging, and I'm getting a little bit away from financing here, but it's quite important because the flag on a yacht would determine where in the world that yacht is registered, what maritime registry it's on, and the yacht would effectively become an asset of that registry. And that registry then provides legal governance for the security that can provide it over that particular yacht. So, for example, if a yacht is flagged here in Germany and it's on the German Maritime Register, it would be a German law ship mortgage or marine mortgage on the yacht. Is the lender comfortable with that? Well, that's up to the lender to decide. Flags also introduce then other regulations for owners. So they regulate the safety and compliance considerations for yachts as well. They also determine what you can and can't do when it comes to commercial or charter operation of the yachts. So again, sort of thinking about where in the world the yacht might need to be used, whether it would be commercial or private, what sort of flag might be ideal in that context, are all important considerations really before speaking to lenders, because a lender will have a shopping list of questions so that they can form a view on whether or not they have an interest and whether or not your transaction or an owner's transaction might fit the sort of financing they want to provide. And as a follow-on from flagging, I'll briefly mention VAT, because if a yacht is being operated privately, and certainly if it's under an EU flag, VAT is typically applicable on that yacht, and that can be a substantial charge, can be well north of 20% depending on the EU jurisdiction involved. This is really an EU consideration. If it's operated commercially and is registered formally as a charter yacht, there are ways to perhaps defer that VAT. There are various sort of options and schemes available in different EU jurisdictions to manage VAT. But again, sort of understanding and giving some thought to whether it's private commercial operation, is VAT going to be paid on the yacht, is it not, are all important questions that the lender will have and really like the client to have thought about. The yacht manager is also important as well. Often owners aren't captains. They may be at the smaller end of the market, but as vessels grow in size, owners typically aren't captains of their yacht. They want to enjoy it for a few weeks a year. They're not necessarily wanting to operate that yacht, or they may not have an interest in it. Considerations also need to be given to who's going to arrange for the crewing, who's going to arrange for all of the maintenance, and just monitor and handle all that. And there are a lot of yacht managers in the market that would welcome the opportunity to do that. That's what they specialize in. Lenders will want to understand who's going to manage that yacht, because they will be reliant on them to be looking after and almost be a custodian of that asset on their behalf. It's their security, and they want to know how well it's going to be looked after. Now, perhaps on to financing specifically, I think an important question, I suppose, that the buyers might have is, how do I find a lender? That's a real challenge in this market. It's very rare that you would walk down a street and find stores or banks that are advertising that they do marine financing. There are certain parts of the world you might find that, but for the most part, a lot of the lenders are names that people haven't necessarily heard of. The private banking community I mentioned earlier are probably the exception. What I would say to buyers is, if they have a relationship with a good private bank already and they're buying an asset of sort of 15 million euros and above, that's probably a good place to start. Have a conversation with your private banker. Does your bank have an interest in providing yacht financing? If they do, it might be worth you getting a term sheet from them just to see what sort of terms they might be able to offer you, and just, that's a data point for you, really, a starting point. I wouldn't necessarily encourage you to take those terms and run with it. I think what a buyer should think about is, okay, well, that's one option I have. What are my other options in the market? Maybe I can consider other private banks, maybe dry lenders, and exploring those lenders in the market. Now, there are a number of ways to find these lenders. I mean, some clients might sort of sit on Google and try and find lenders. I think one of the dangers and traps there is, if you Google yacht finance, and if you did it now, you would find probably the page that you would get would be half banks that generally provide yacht financing. half the page might be yacht finance brokers, like me, but it may not be that clear on their page whether they're a broker or a direct lender. Sometimes it's difficult to, for buyers that aren't in the market to understand whether they're talking to a broker or a lender, because terminology used can be a little vague. But I think finding a number of lenders, and I would encourage sort of 3 or 4, would be good. Then you can compare and contrast terms. But Googling lenders is one way to go. I suppose that's a quick way. Others are just talking to other people in the industry. Talk to your yacht broker that's selling a yacht to you. Understand what lenders are in the market for somebody like me, for the yacht that I'm financing. Who have you seen do other deals? Who do you recommend? Maybe legal professionals as well that have been involved in yacht transactions. Who are they seeing in the market generally providing yacht financing? Who can they recommend? Other service providers, I mentioned the Yacht Manager, they could be a good source of introductions as well. Find a good finance broker in the market. A broker is very helpful because they know the finance market, they know who's lending, who's not, and generally who would be prepared to finance your yacht based on who you are in the world, where you live, what your assets are, what your income is, where you want to register the yacht, the VAT element. All of those components feed into lender appetite, and so a broker can determine quite quickly, if they're a good broker, who might be interested in lending, and they can guide you on what those terms might look like. I would encourage sort of 3 or 4 term sheets if a buyer can, so that they really get a feel for what the on-market terms are, because there is a huge array of different terms in the market, whether it's the amount lenders are willing to lend, the interest rate that they charge, the security and broader collateral package that they expect. And so I think buyers or owners should get a good feel for what is really on market. I think if you just take your first term sheet and run with it, there may be other options in the market that you're missing out on. You could maybe be able to borrow more, cheaper, perhaps provide less security. Again, talk to as many people as you can just to get a real feel for what's available out there. And on that point, talking about the terms that are available. So most lenders globally, whether it's private banks or dry lenders or private lenders, would typically lend between 50 and 70% against the lower of cost or value for a yacht. Sometimes that can go up a little bit to 75 or even 80%, especially if it's part of a relationship lend with a private bank, or if the transaction is taking place in the US market, if it's a US client and a US lender. Again, with a more developed market, leverage can be a little higher than it can in the rest of the world. But that sort of range is pretty common. I would say typical for a European client would be more like 60% loan to value against the lower of cost or value on the yacht. Interest rates are often variable in this market. So in euros, it would be above the euro base rate, which is Euribor. It's currently about 2.75% at the moment as a base rate, and lenders would charge a credit margin on top of that, which can be anywhere between 2.5% to 5.5%, really, depending on the lender concerned. So private banks will be at the lower end of the market. Again, they're introducing or including a component of the relationship value as part of that pricing. So they're thinking about what else they can make in terms of fees from the broader relationship, and to an extent building that into discounted credit pricing to encourage clients to continue to bank with them and build a relationship with them. At the higher end of the scale, it might be leasing companies, sort of some of the smaller credit providers. In terms of security, a lot of lenders are looking for if it's a straightforward loan and mortgage, it'll be a mortgage over the yacht. And assignments of the yacht's insurances and any warranties and that sort of thing. Typically, yachts are owned within another corporate vehicle, so the shares of that corporate vehicle, or an SPV as the industry calls it, would be pledged to that lender as part of the security package. And invariably, the loans for yachts are what the industry calls full recourse. So that effectively means the owner or the beneficial owner would be expected to provide a personal guarantee for any loans or leasing required for financing. So unlike commercial assets, these are not financed standalone, and so if a buyer should take out financing on a yacht and for any reason is unable to pay that yacht, their own assets independently of the yacht could be at risk if the yacht isn't sufficient enough to repay that loan at a future point in time. There are very few lenders that would do what we would call non-recourse financing, and those that would be open to that, would probably want to do a very low loan-to-value or advance rate. So you might be looking at more like 25 or 30% advance against the value of the asset to begin with, if you were to not provide recourse to a lender. But again, it's very few. Recourse is very common. I think then once you've identified the right lender for you, there's a credit process to go through. And if you can, I would encourage buyers to try and run that credit process with more than one lender, maybe a couple of lenders. Some lenders will want fees up front as some sort of work or engagement fee, because the last thing they want to do is go through the internal approval process and do a lot of credit work to have a client finance their yacht with a competitor. So sometimes that's acceptable, sometimes it isn't. Often these things are negotiable, but the credit process can take a bit of time, and if a buyer or an owner is subject to sort of a short timeline, again, the last thing they want to do is run a process with lender number one to find out that things aren't working out or taking too long, and they have to start the process again with a second lender. So having a backup option or a plan B is always something I would encourage. Now, that credit process with lenders can take a bit of time. For most lenders, it probably takes a month to go through that credit process. And often that's where clients have a bit of a bumpy ride, because the lenders will typically expect clients to be very transparent with their financial information, so they're going to be looking for clients, again, in the context that they're expecting the owner or the beneficial owner to provide a guarantee for the financing. They're going to be looking to understand who that beneficial owner is, what assets they have, what other financial liabilities they have, what income they have to support that guarantee. And the lender's perception of value and strength in that financial guarantee often then feeds into how much they're willing to lend against the asset and the interest rate they charge. So the more transparent a client can be, and the more detailed a presentation a client can give, often the greater the strength they'll have to negotiate those terms as they move forward with that particular lender, and the faster the credit process will go through. So often when I work with clients might provide like sort of a self-prepared statement of assets. They might say, these are the properties I have, these are some of the business or commercial investments I have, and where those commercial investments are a material part of the client's overall wealth and income. Often lenders want to see 2 or 3 years financial statements for those corporate investments as well. Sometimes clients want to show them, sometimes they don't. But again, the more transparency, the faster the process can be, and often the more attractive the lending terms that those lenders are willing to provide. I think if a client can package their personal assets and liabilities and any supporting corporate financial statements, sometimes personal tax returns to evidence their income to lenders fairly quickly, the lender's process can be expedited, and maybe it's 2 or 3 weeks instead of 4. But often you'll have somebody in a credit team within a leasing institution or a bank that will do some initial due diligence and ask some questions to the client around, okay, well, why did you buy this asset, or are you renting this asset? Is there any income? Perhaps there's some variability in the financial statements, and they want to understand a bit more about what the buyer's corporate interests do, a bit more about the market they're active in, some certain challenges they might have, just to form a view on credit worthiness, really. So a lender may take a month or so to work through that process, and then if they approve a financing transaction, there's then a documentation process, which is issuance potentially of commitment letters, certainly loan documentation or leasing documentation. Importantly, there's security as well. If we've got an asset that is going to have a mortgage placed over it, a lender will want to engage a law firm, for example, in the jurisdiction that asset will be flagged in to register a mortgage over it on their behalf. All of this can take additional time to review, negotiate, and put that security documentation in place. And so, buyers should probably budget another month or so for that to be done. And so you're looking at, from the point of receiving term sheets, I suppose, determining which lenders you're happy to proceed with, to really getting to a point where a transaction can be funded, I would say it's 2 to 3 months is probably a reasonable time frame. And again, owners should think about that when they're thinking about financing. Often financing is an afterthought for buyers, perhaps because they had no intention of taking financing to begin with, and for whatever reason financing now becomes something that they're interested in. But that 2 to 3 month timeline is pretty common across the industry. Now, with private lenders or credit funds, they can perhaps be a little more flexible and they can accelerate those processes. I would say, they can probably close within a month, sometimes as quickly as 2 weeks, but they are significantly more expensive. But they do serve a purpose in the market, and they are incredibly valuable. And I've used them for a number of different clients that have a need for, perhaps accelerated financing or very short-term bridge financing.